Hello and welcome to our 2026 Real Estate Outlook. My name is Lowell Baron. I'm the CEO of our real estate business. I'm joined here by my colleagues, Brad Heiler, Co-President, Head of Europe, Ben Brown, Co-President and Head of the Americas, and Ankur Gupta, Deputy CIO and Head of Asia Pacific. Guys, it's great to be here with you. We're here together actually at one of our most recent acquisitions. This is the Sheraton Phoenix 1,000-room hotel that we just acquired. And I think as we get into the discussion and talk about what we're seeing as we've gone through 2025 and our outlook into next year, I think this actually will be a good example of the kinds of opportunities that we're able to unearth that are really attractive investment opportunities, high quality assets, good cash flow, but importantly, great fundamentals. Why don't we start by talking about where we are in the cycle? The real estate cycle has gone through a tough time over the last number of years. Feel like we're in early stages of recovery, but where do you feel like we are? Maybe Brad, we'll start with you.
Feels like we're certainly recovering, albeit uneven. And we knew it wasn't going to be an immediate bounce back and a straight line up. I think when we sat and talked at the beginning of the year, things were feeling a lot better. Transaction activity was picking up, liquidity was coming back. And that held true through the first quarter. Then we saw a bit of disruption around geopolitics. A bunch of transactions we and others were working on sort of went sideways in the second and third quarter. But now, fourth quarter, things have ramped back up again, and it feels encouraging in terms of the direction going into next year. It certainly feels still early to mid-stage, but we haven't really seen a full bounce back in activity the way that maybe we would have thought a year ago.
It feels like if we rewound the tape, what we thought would happen this year, and where this year feels like it's ending, those may look somewhat linear, but actually what's happened in between is very different than any of us had anticipated. But we have seen, for the right kinds of assets, there is liquidity. But debt capital markets are supportive. There's plenty of dry powder on the sidelines waiting to be invested. So liquidity has returned and it's been more constructive. But as you say, it's not uniform, right? And so we've been in an environment where there's still those air pockets of dislocation. And that feels like what we've probably been most active on this year. So when you take that into account, what does next year look like? It's probably more of an evolution of that and finding where do those spots continue to exist when we're deploying capital, where we can find really good opportunities, where there's value and there's supportive capital markets.
I'll just add one word to that, like just confidence, given how supportive debt markets have been, how supportive our best assets when we look to recapitalize those have been through the course of this year. It just adds to the confidence that we have in the markets. At the same time, there are pockets of dislocation still. So opportunity when we really were convicted about a particular idea like this one.
Yeah, I want to push on that for a second because I do think the first ingredient in recovery is the capital markets. It is credit. We've had a great year from a financing perspective. Credit markets are pretty wide open. And by the end of the year, end of 2025, we'll be at almost double the financing pace that we were at just a couple of years ago. So that's a good indicator. Ben, maybe it's interesting just to talk about what we're seeing in the capital markets, even in what has been one of the tougher sectors from a conviction standpoint in office. And even there, we're seeing that positive view.
Yeah, look, it feels like if you have the right attributes, the financing markets are super supportive. So that's the right asset quality, location, profile, and right sponsor. And I think we've seen that come through across our business. So as you say, we have done 2 over $1 billion US office financings, standalone financings. We did a over $2 billion retail mall financing and almost a $2 billion resort hospitality financing this year. So things that, I'd say superficially look like they would be more challenged profile-wise. We've seen very, very supportive capital markets, and we've taken advantage of that. And I think that will continue to play through markets globally, but a lot of existing capital structures, existing sponsors that are capital constrained. And so while you have a good backdrop of fundamentals in the capital markets, you still have a fair amount of opportunities that will lead to the needs for recapitalizations, for equity top-ups and bridge equity, and frankly, just catalyst transactions.
Yeah, the credit markets help fuel the wheels of transactions. Right. That's happening slowly. And maybe from our perspective, it's worthwhile talking about what we've seen as we've been out actively selling assets, so we can see where is the appetite for assets. We sold about $17 billion of assets this year, so we've been probably one of the most active sellers. It's been across all of your regions. Worthwhile to just talk a little bit about what you're seeing in your region. Where has been the demand for capital, and how have we had that success?
In Europe, we've seen some large global institutions refocus on Europe, and maybe ones that had been looking at the US or other markets have now approached Europe in a more constructive way with, call it, lower cost core plush-ish type capital to do larger transactions. And that has been a relatively thin part of the market and still is in many sectors, but some sectors which are in favor that have very strong tailwinds in demand and low supply, like student housing. So we sold a large student housing business to a global sovereign wealth fund, pension fund type investor. And we've got several other businesses in that sector or in alternative living or alternative hospitality, which we're either in the market or likely to sell in the next 12 months. And there we're seeing competitive dynamics of global, mainly non-European capital looking for platforms, businesses they can buy that are good assets, well run, and they can continue to invest capital going forward and keep growing. But on the other hand, some large portfolios, it's very thin, where it's just buying a collection of assets. There isn't the traditional core buyers that historically have been European, whether it's been German funds or French funds or open-end vehicles. Those have not come back to the market. So the traditional core has been quiet, but some large global investors are reawakened and are looking for very specific things in Europe, and we've been trying to take advantage of that.
It's been very interesting in that regard that best-in-class operating companies are sellable. There are sovereign wealth funds, pension funds that really are excited about these unique opportunities. The other side of it that's been pretty active in selling has been single assets or smaller portfolios. And Ben, I'm thinking of you because of all the activity we've been doing in industrial in the US. Maybe you could comment on that.
I think it's the other end of the spectrum where you have a tremendous amount of capital and expertise on a smaller scale, mainly regional, localized, where you have a tremendous amount of a breadth of a buyer pool for assets below a certain size. So when we talk about where's their liquidity, tends to be larger things. We have a competitive advantage being able to do things of scale. There's a lot of people that can do a lot of things not at scale. And we've been probably most active there in the US this year on dispositions. That means the number of transactions that we've done have multiplied for sure over what we traditionally do in a single year. But we've just pivoted to where the market is more efficient, where we've seen that liquidity. So I'd say we've seen that's been true in logistics. That's been true on the housing side. And so we are finding pockets where we're selling traditional apartments or single family rental. And then it's actually been true selectively on the hospitality side too. Smaller assets that smaller groups can take and implement a business plan. There's still a pretty good bid out there for that. But I think the key here is, passive thematic investing is just not fit for this environment now. And I think there's a recognition of that definitely on the institutional investor base. And so they're looking for platforms that they can scale and have expertise. And I feel like you get paid a premium for that. And I think that's mostly what we've done.
I mean, part of the reason is that there has been such a strong economic activity, certainly in many, many economies in Asia-Pac, that inherently operating business models have a lot of growth embedded into those operating platforms and management teams that have performed. And Brookfield has been able to, lend itself into the corporate governance and business plans. So when institutional capital leans into those business plans, they see immediate uptake on account of two things: strong underlying growth, but also very, very strong and proven management teams. And in Asia-Pac, there's one more, which is the equity capital markets that are fairly active, both on the REIT side as well as the IPO side. So public markets are equally constructive, as is large sovereign pools of capital, both domestic and international. I think that's certainly created a lot of credibility to operating businesses as we see them.
I feel like that sets a pretty good framework for where we sit today and how the capital markets are acting and where the capital is concentrated. Maybe let's pivot a little bit to the opportunities. So what are the opportunities for us as we sit here today and going forward? We've got a pretty deep pipeline. We've been very active investing capital over the past number of months.
Yeah, it's maybe little bit on the illiquidity or maybe lack of depth to liquidity for those portfolios that are large, that there isn't the same bid there has been in the past, but there's a seller who needs to sell because they've compiled this portfolio over the last 5 to 7 years. It's in a closed-end fund, and they need to exit. They could sell down asset by asset, but it will take them several years, or they could sell that in bulk. And I think that's what we've been looking at and going into sponsors and sellers where we know they have that condition and essentially cherry picking what we want and coming up with portfolios of reasonable scale that then we can go through the last phase of the business plan, any remaining value creation, and sell them down over a period of time. We've been looking at those types of opportunities because there's still a lot of assets that need to rotate. Yeah. And we're now 3 years into this phase of the cycle with a lot of pressure that's built up. So I do think we'll see more of that.
I agree. I think that's going to be the interesting story over the next couple of years because yes, now we have transactions where the markets are moving, volumes are up, maybe 20% this year over last year, but continuing to grow. But they still haven't picked up all that pressure from everything that needs to get sold that wasn't sold over the last 4 years.
And I do think the other thing that's happened is enough time has gone by where we've always talked about part of the clog in the system is the bid and the ask spread. Like it's the most overused term in real estate, right? It just means we're not agreeing on price, therefore we're not selling. Enough time has passed. We're in an environment where rates are declining, but probably not at the pace. And I don't think yields are declining at the pace that people had expected would find themselves just wading into a recovery. And so that is just meaning like there's just more capitulation setting in. And that's going to drive all of what you just described, right? So it is illiquidity plus capitulation and the fact that things need to rotate. And so there's going to be tons of opportunities. The thing for our business is, okay, like where do you focus and where do you find value?
And I'll just add to the last point, Ben, you made about the teams. There's so much underlying value add that we can do immediately to these portfolios because there has been a bid-ask spread where capital investment back in the assets have virtually stopped. Cost of capital has been higher for motivated sponsors. We're just waiting for the right time. What we're seeing across our region is almost an immediate 30 to 40% increase in value or underlying cash flows of businesses that we are buying, either on account of better cost management, better leasing, or better operation. And I think that is a perfect storm where we are buying for value, but are immediately seeing a value uptick as well.
It talks a lot about how we buy, trying to find motivated sellers. We're looking for the right size. We're not competing with anyone. We get good pricing power. But let's dig into what sectors, like what property types, what sectors, maybe each of you just pick one that you're spending time on that you think across your region is the most active, the most interesting.
We've said for a long time, this is probably the best environment that we've seen in a decade. So then you got to work your way through, like, where do we see the best and deepest value? And like, when I think about the answer for what we're seeing in our region, we could go through the sectors and a lot of our answers will be the same. It'll be housing and logistics and digitalization, data centers. And we'll talk about those specifically sector-wise, it'll be true. But I think what's maybe interesting now is how do we define where we're finding value? We're in an environment where we've been seeing some of the businesses that we're buying or have bought this year, businesses that we actually, in most of our strategies, couldn't get access to. Either weren't for sale, not at our cost of capital, or just no motivation for someone that had owned these things for a long time.
I'd say maybe hospitality in Europe, and it's still a little bit of the the lingering COVID impact that's still playing itself through, where a lot of hotel owners in Europe survived COVID, and they, to our surprise at the time, if you recall, they hung on to their assets. We bought one platform during that period that was in deep distress. We've turned it around, we put the CapEx in, and now we're selling off assets and we'll sell the business and it's going to be fantastic. But a lot of other businesses and platforms survived. They took on more debt, they took on government furloughs, and then demand came back post-COVID with the recovery and the American consumer really driving a lot of the leisure demand. But now the assets are gone through 3 years of real underinvestment, undermanagement. The demand is starting to peak a bit. So being really selective and figuring out great real estate in the right locations that's been undermanaged, underinvested. But Europe long term still has fundamental, great fundamental demand drivers for leisure assets in capital cities and holiday destinations. And we're generally focusing on higher end product, which is a bit more resilient, or sort of niche strategies, which again fit the demographic in the continent.
Yeah.
Ben, what about you? What's out there?
I'll probably give you the same answer I gave you last year, which is housing. I mean, undeniably, we've been busiest on housing, and we continue to be. We've got affordability issues, and we've got aging infrastructure, aging population, and academic infrastructure that needs more housing. All of those things they really create fantastic tailwinds for rental housing generally. And we've now got real supply constraints. I mean, the cost to create new housing is probably up from hard, soft, and financing costs 25 to 30%, maybe more in some markets. And home affordability has only gotten more out of touch for most Americans for sure. And then you've got, even in our business in Brazil, where we continue to see the ability to scale and add more inventory to this sort of burgeoning class of institutional rental product, has just been fantastic. So I'd say we've been busiest on housing for sure, and I think we will continue to be. Yeah.
I'll just add the third part of it, which is, Brad, you touched upon lodging, living, logistics. I have to talk about it because that's again a global theme, certainly in APAC. Fundamentally, we still believe that global trade, or the Wall Street Journal around global trade, has just been overplayed. Just in terms of data, 51% of all trade from Asia happens to within Asia. Only 18% happens from Asia to the US. So even if you see a small change because of policy on tariffs, it still is a huge market for what is an underbuilt and continues to be an undersupplied lodging market across APAC. We've invested in certain situations in South Korea. We've been building out infrastructure in logistics in Australia as well as Japan, and more recently in the Middle East and India, where there's just pale supply compared to the economic activity that fundamentally drives value and uptake in this sector. At the same time, I would say that the office sector in Asia Pac continues to be very, very strong. We've talked about it for many years now, how India, Middle East, parts of Asia like Japan and South Korea, we just don't have a square footage of supply in many of the markets. In top cities like Mumbai and Seoul and Tokyo, all of our assets get pre-committed before we even start the leasing program. So across the board, sectors like logistics, like office, which are fundamentally around high GDP growth and supply that takes time to come online, have performed very, very well and continue to do so. The one aspect of living in Asia that I'll say is the alternative sectors around living. Could be serviced apartment, could be student housing, and self-storage, which are a good proxy to where housing prices are going, that create need for these specialized sectors.
Those are good answers to the positive question. The harder question is always, which places are we cautious? Like, are there sectors, markets where we are cautious? You mentioned office in Asia being a positive. How do you guys feel about office across Europe and the US?
I'd say generally speaking, we're cautious about secondary and tertiary assets generally.
Yeah, I agree.
I'd say certainly probably office is the most acute, but I would say the same about really all sectors. And when the market reprices and you see opportunities that screen at high yields or what look like high yields relative to better locations, many opportunity funds would gravitate to that. But I think what we've tried to do is be really, really selective and disciplined about making sure we're sticking to prime locations, prime markets, where we can invest in quality or invest in assets that we can turn into, highest quality assets. So offices, certainly that's true. The occupier market in central London, central Paris, central Madrid, the major German cities, is certainly seeing more demand for the best assets than there is supply. And it's very difficult to justify new development in any of those locations. But there's a lot of secondhand stock and secondary buildings that need to be renovated, that need to be brought up to a higher standard. But we really only want to focus on the very best addresses in those markets and not get distracted by going outside of the core.
In this environment where people are talking maybe a little bit too early about rates going down, we have to be cautious about low cap rate markets as well. Certainly in geographies like Japan, where 10-year yields have moved to 1.7% now, practically negative, not too long back. Just have to be careful that there will be business plans that will come our way, which talk about compression in cap rates on the back of lowering of interest rates. That could end up being not so pretty for many business plans.
Yeah, I think we tried to stay, and I think all of us, really disciplined about where we think exit values are going to be relative to today's cap rates, where yields are today, what's tangible, what we have visibility on. Even though in some places like the UK, as an example, our expectation is rates are going to come down in the UK over the next 12 months, and cap rates probably will come down with that, but we're not basing our investments on that thesis.
It feels like we've all been aligned on the construct that yield compression, where rate compression is optionality. None of our business plans rely on it.
Absolutely.
And if we get it, I think that's where you get some asymmetric upside. Maybe I would add, just in terms of caution, one of the places that we've been very disciplined on and pulled back pretty meaningfully is just on development generally. And then look, life sciences has been an area where there's been a real pullback in demand and oversupply in the US. And we've watched that story play out the past couple of years. This is the first time in 2 years that we've started to see real momentum around occupancy, both on the West Coast in our San Francisco portfolio and on the East Coast. And I think this could start to be the turning point of where demand starts to normalize. We do have this overhang of supply that we'll work through. But that's been a place where we've been cautious, that I could see us, as we watch markets, potentially flipping into being a little contrarian and potentially getting more aggressive. In the Americas, we've been very, very patient on office, but I would say our lack of activity on office is less about our desire on what we would like to own. It probably goes back to your point, and what we've been able to buy hasn't just aligned with what we'd like to own. And probably on office, where we've played that, is probably more on the credit side, where we're really seeing a better risk-adjusted return, where you can structure a really protected basis. You don't need some of those business plan inputs to sort of come your way. You can underwrite today's values and today's rents and today's occupancy figures and still get paid a couple hundred basis points higher than other traditional credit investments today. That feels pretty good. So I'd say there's a place where we're probably more cautious on the equity strategy and probably more finding an opportunity of dislocation in credit.
And I'd say the same thing is true in Europe, where we're seeing really good risk-adjusted returns in senior credit, senior mortgages, where we can take investment-grade credit risk and refinance, really good, strong office buildings, but also other asset classes too. The market has become pretty competitive in terms of mezzanine funds that are looking for relatively high returns. But the investment grade mortgage market is actually, the depth is not there. And that's where most of the volume is with all of this walls of refinancing. So partnering with insurance companies, with institutions, we're seeing a huge flow of activity, and we're able to leverage our teams and the information we have to really pick and choose what are the best credits.
In Asia, 90% of CRE debt is bank held. And just the movement of that paper from bank balance sheet into private hands is something that Brookfield can certainly play a big role, and we see that happening over the course of next couple of years. Creating asset managers on the back of our experience of doing so much equity in these markets is something that we feel would be a tremendous value add for us in growth of our global credit business. And many markets like Australia and India, and certainly offshore-based lending markets in Singapore.
I feel like this year all we've heard about in the world has been talking about AI. So maybe comment on where you're seeing AI actually directly impact real estate and in the way we think about real estate now and maybe over the coming year.
The most direct impact is on our industrial lands that we thought could be warehouses becoming data centers and more. And just the convergence of compute being measured in power in power versus square footage, and the dependence it creates to having strong public partnerships around our entitlements. I think that's something which is directly correlated to our investment activity. And we are finding tremendous opportunities across the world in being able to convert high quality business parks or industrial parks into AI supercenters. Brookfield has a natural advantage that a lot of AI will be sovereign-led AI. And we've shown examples of doing that already. The proliferation of that from the US to Europe and then economies in Asia is a trend that we are seeing directly impact our business across the board. At the same time, compute has always made its way from large supercenters to offices and to our homes. The development of that diffusion of technology into our everyday living is something that we are seeing already, whether it's robots being trained to run warehouses or even homes right now.
Yeah, there's the investment side, and I'd echo the same in Europe, and taking a lot of our existing land or developments and seeing if we have upside to convert to data centers. The development margins are significantly higher, and land value enhancement, if you can go through that conversion, the reward is potentially great. I'd say on the operational side, a lot of the operational businesses, we're actually seeing real tangible results by using the technology in yield management and really driving margin improvement. So I was in a board meeting with one of our hotel companies, and they walked through where they're implementing AI, both on the cost side to control operating cost, as well as on the yield management and revenue side. And we're seeing real margin improvement. That's tangible. That's a return on investment, which is probably the first time I can say that where I've actually pointed to numbers that have come through.
Yeah, look, it's a second derivative answer, but the San Francisco office market and the activity we've seen across our portfolio has been a direct beneficiary of a lot of the activity around AI. We've seen a tremendous amount of pickup from the occupier base in the epicenter of sort of AI growth in the U.S. In that office market, and that's going to scale into other markets and provide another leg of tailwind on demand for sure.
Maybe just to wrap up, I would ask you guys to finish this sentence, which would be, my best idea for 2026 is, and I want each of you just to go ahead and answer that, finish that sentence.
Public market dislocation, both in the positive and the negative.
From a buying perspective and an exit perspective?
Yeah, absolutely.
Yeah, so I would say the best idea and the place that we're spending the most time will continue to be housing. I think we've been really active this past year on rental housing generally across all types, and I anticipate that to continue into next year. And what we've now built up across the organization is really an expertise across all rental housing types, and I anticipate our ability to take advantage of that, both at scale and doing things a little more tactically.
Yeah, I would say I'm most excited about the opportunity of more platform creation in the sectors we really like housing and hospitality primarily, but potentially others. Taking all the lessons we've learned in other geographies and other regions and applying it to new opportunities. In Europe, that at the moment is mainly in alternative housing. Mm-hmm. So what we've done in the UK, Germany, France, we're now doing it in the Nordics. We're going to go to Italy. Senior housing, which we've done successfully in other markets. Self-storage, which is another alternative sector I think we're going to be active in.
It's great answers all around. Thank you guys. It's been a great discussion. Really appreciate the time, and thank you everyone for listening to us, and we look forward to a great 2026.